My name's Leah Odom with Homeowners Financial Group here in South Carolina. I've been a lender for 20 years, and a lot of that time was dedicated to learning the different loan types available to people who want to buy a house or create a new mortgage. So today what I wanted to do was just sort of hit the highlights on the different types of loans most people use to secure a mortgage. So we're going to talk a little bit about conventional loans. We're going to talk a little bit about FHA loans, VA loans, and USDA loans. Those are the ones that we see people using most often. There are many more different loan types and variations on that theme, but we're going to talk about just the general topic of what those mean so that when it's time for you to put the next step forward, you have a little bit better understanding what's being explained to you. So here we go. We're going to start with conventional. Conventional is like a private mortgage loan. A private investor is willing to lend you the money, right? And they do it because they're not a charity. They don't want to see you buy a house just because it gives them joy. They want to make money on the interest. That's what this is all about, right? So the way that they do that is they allow you to put down X number of dollars, and then they're going to put down X number of dollars that equals the sales price on the house you like. Now, when you don't have 20% down, just to use an example, a $200,000 house payment, that's $40,000. And it's hard for any household to save up $40,000. So they do have options allowing you to put down as little as 3% if it's your first time buying a house. But when you do that, you get to pay PMI, or private mortgage insurance. So that's sometimes something that gives people a little bit of heartburn. It's not a bad thing though, because even if you had $40,000, I might say, hey, that's not the smart track to go. Might be better to save some of that money or invest some of that money that's also going to earn for you instead of putting it all into the house. It all depends on a few key elements to your scenario. And a good lender is going to do that. They're going to take a look at what your goals and your targets are so that we can best suit the loan to meet that need. So conventional is one of my favorites for the other reason that if you have PMI, you can actually see it go away. So if you're making your payments on time, or even the savvy homeowner making extra payments against principal along the way, you're building equity quicker. And once you've got 20% equity, you've paid enough to get to 20% equity on your home, the PMI can just be dropped. You don't have to refinance or sell your house to get rid of it. You can request that the lender actually drop it. So I like that. I think that that gives you some goals to making extra payments, as well as the opportunity to lower your payment yourself without having to spend extra fees to do it. So I love conventional. It's always where we start. We kind of want to start there. And when I'm comparing loans for a borrower, that's what I start with. So the next loan that I look at always is FHA. So an FHA loan is a loan that's insured by the government. Remember, we had PMI on conventional. It was an insurance company that was providing that insurance policy that protected the lender. FHA is the government saying, hey, we're going to put this out there. And by the way, FHA has been around since the New Deal. It's an old program, but it's great for somebody buying their first house. You only have to put down 3.5%. You do have the equivalent PMI called mortgage insurance premium. You have it two ways. You have upfront and then monthly, but it's great. It's easier to qualify with. It's not as tough as conventional to get approved for, and they have some great elements to it. So it's a wonderful, wonderful loan type. It sometimes and usually often has lower interest rates or the same interest rates as conventional. So those two really do compete with each other on a lot of different levels. But I think FHA is a great loan. It's a great way to start. It's the way we bought the house we're in today, and we refinanced it to conventional as soon as we could to save ourselves that PMI. So there you go on FHA. My next loan is actually my favorite loan, and it's a VA loan. So let me explain. A lot of people think that the VA has to be the one to secure a VA loan for you. That's not true. Any lender can do a VA loan if they've got permission to do so from the VA. So most lenders, in fact, can do VA loans. What I like about a VA loan is that there's a lot to it that's sort of common sense. Most lenders look at your gross income. VA looks at your gross income, but they also look at what's left over after you pay your bills, and they take into consideration things like utilities and how many members of the household do you have to feed every month. So I love that they go that far into protecting our veterans, because that's literally what they'll tell you. That's what the purpose is in that, is that they're protecting our veterans, and I love it. Active duty service members, veterans, or widows of veterans that died in service, those are folks that are eligible. So not everybody can get a VA loan. You do not have mortgage insurance and you have 0 down payment. It's wonderful. But the reason you don't have mortgage insurance and you don't have to put money down is because the VA is guaranteeing it. Just like insurance for FHA and conventional came in to protect the lender, the VA is going to protect the lender in case you foreclose. Same deal. So love the VA loan. Again, it's one of my favorites. Easier to qualify, kind of like FHA that way. And they do have a couple of peculiar rules, but for the most part, I mean, if you're a veteran who's got eligibility and we can document your income, you should be good to go. USDA, wonderful loan. It's got some limits to it though. So this is a loan that requires you to do a little bit of homework before you really start out looking at homes, because USDA loans have an income limit and it changes by the county you're looking in. Not only that, but some homes within the same county, some might be eligible, some might not. So you really have to look it up by the address. I actually have a map that I go to look and see if a particular property address is eligible. So you want to do that background work beforehand so you can kind of identify what areas and is your income going to meet the maximum standard. So also remember, it's not just you, it's everybody in the house over 18 that collects income, that we have to look at all of that. So be prepared to give that to your lender so that they know up front and you have no surprises later on. So that's the 4 most common ones searched out. Again, there's many other types of loans out there that I think you'll find, but these are the 4 we talk about the most often. Again, if you have any questions specific to South Carolina lending, just leave the question below in the comments. I'll be sure to get back to you. Or you can reach out to me directly at my contact info in the description. Be glad to answer those questions anytime. Hope you have a great day and happy home hunting.